From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, stalling Treasury yields searching for a new narrative. With bond volatility fading amid continuing transitory talk and the junk bond boom wavering after posting one of its worst months since September. We begin with the big issue, stuck in transitory purgatory.
Either bonds are flat or they're up a little bit.
Yields aren't really moving.
Bond yields have kind of moved sideways for the last few weeks.
They're not giving you that big movement.
Basically, the market is catching up to these inflation expectations.
No one knows if these inflation pressures are going to prove more transitory or less transitory.
What you see right now is very similar to what we saw in 2012 and 2013.
Nothing's moving.
The bond market's going to have to deal with what appears to be, for the time being, transitory inflation.
The degradation and efficacy of bonds as your primary hedge.
It'll be very interesting to see how that plays into inflation.
This range-bound thing.
This is a big deal.
Nothing's moving pretty much sums it up, yet still it is interesting. Joining us now, TD's Priya Misra, Bank of America's Matt Diczok, and Krishna Memani of Lafayette College. Let's talk with you, Priya, because it's a strange complacency in a debt market amid some inflationary data that's coming out at the strongest levels in nearly 30 years. Is the market too complacent?
I think the markets is almost believing the Fed too much. I am a little concerned that the long end of the market may be a little too complacent here, because what we've heard from the Fed is they think it's transitory. Our view, looking at the underlying components of the inflation number, also look transitory to us. But there's a lot of supply that's coming down the road. We have very high deficit this year. We think another $4 trillion is going to get added, and high deficit next year. So I do worry that if the Fed at some point starts to talk about tapering, which we think will happen in the fourth quarter, the long end's going to wake up. That drop in real rates, I think, is a little overdone in the long end. I think the front end is anchored, but I am a little concerned that the Fed taking the first step towards tapering will come as a big shock to the rates market.
Matt, do you agree? Do you think that talking about tapering is going to become a problem?
So we don't think it's going to be a problem, although we do agree with Priya that we think the move in rates is going to be upwards. But it's interesting. So if we do expect, as Priya just sort of said, tapering in the first quarter of next year, well, then they'd probably start talking about it publicly in the fourth quarter of this year, which means about talking about it at the FOMC meetings in the third quarter, which means what you saw in the minutes the other week, that they were starting to talk about when they were going to talk about internally talking about the taper makes sense. The timeline is okay. But there are certainly a couple of reasons, real fundamental reasons why rates are not moving up. The first being the market really thinks it's transitory. All you need to do is look at the inflation break-even curve. It's about 3.3% in 1 year, and then it goes down to about 2.3% for 10 years and out. So the market definitely thinks it's transitory. Secondly, if you're a global investor, look at the two other largest developed bond markets. Look at Japan, look at Germany. They're still at zero or slightly negative. So there's not a lot of choice. We're actually in a very middle of the range valuation versus German bonds over the last 5 to 10 years. And finally, we have seen some of the economic data, particularly the soft data, start to weaken a little bit. We started to see consumer confidence start to stall out, and future expectations actually start to dip a bit in a couple of the surveys we look at.
Yeah.
So that's telling you these higher prices are not being automatically met with consumers going out and buying more. It's with a little bit of hesitancy, and it's starting to weigh on consumer sentiment. So that's some of the reasons that we haven't seen yields move up yet, although we do expect them to continue to move up towards the end of this year.
Oh, Krishna, I believe that you agree here with what Matt is saying, and yet I'm wondering then how you dismiss the data that we got, for example, today, showing that core PCE data, which is the key inflationary metric that the Fed looks at, was the highest that it's been since 1992.
Well, so, I mean, that is really not that unexpected. When you have the sort of boom coming out of the COVID drawdown, that is to be expected. Whether that is because of supply constraints, higher demand, I don't really know, or nobody really knows. But it isn't as unexpected as it would seem. The real issue is once you trim down the outliers, what does the trend look like? And I think any trimmed mean measure that you can come up with shows you that once you throw away a couple of measures, it's looking far more benign than it would be if there was going to be an inflation uptick on a sustained basis. So I think that's what the driver for the market is. The outlook for near-term inflation prints is probably still high, but I think when you go further out, 2022, and when you look at growth outlook and inflation outlook, it's not going to be at the same level as we have had in 2021. And that is the driver of the so-called complacency. Maybe it isn't complacency. It is the markets thinking about things the right way and reacting accordingly.
We'll take a look at the implied volatility in Treasury yields. This is the Bank of America Merrill Lynch Move Index, and you can see that it's fallen to the lowest since earlier this year, absolutely plummeting so far this year, which raises a question: what could trigger a move to 2%, Priya, like you are expecting? And Matt, like you are expecting, Priya, what will the trigger be if it's not enough to see just the data at this point?
Sure. I think the Fed is telling you that you can't extrapolate from the data. So we've been short vol actually for the last 2 months. I'm happy to stay short vol until Jackson Hole. But there are two things that I think can move us out of the rate range we've been in and move volatility higher. Number one, if the $4 trillion President Biden's package passes, I think that does put upward pressure on growth, on inflation. And at the margin, it moves Fed exit a little earlier. So let's see if that passes. Our view is that the Democrats are going to likely pass this through a partisan basis in the next few months. The other component is, when do they really start to talk about tapering? And when do they put it out there on the horizon? Because then we need to find the marginal buyer of treasuries. And maybe it'll come from overseas, but we have tons of treasuries to auction 3 weeks in a month. There are auctions. So I think when tapering is clearly on the docket, I think that's when rates start to reprice, because we have to bring in that marginal buyer outside of the Fed to take all the supply down.
Krishna, before we get into some of the supply-demand dynamic, I'm wondering, from your perspective, do you see the increase in supply in the United States as weighing materially on the market, potentially setting yields higher in and of itself?
No. So this is a conversation we have had on this show numerous times. I think kind of divining the level of rates, especially U.S. Treasury rates, based on supply and demand alone, I think is really not a very worthwhile exercise. You have buyers and sellers materialize depending on what the policy drivers are at that particular point. All the people who are buying equities today, if things go badly, will all of a sudden become buyers of bonds. So no, supply and demand really isn't the driver. But I think Priya made a very interesting point, which is inflation has gone up. So real yields has really has gone down meaningfully. And I think if the taper talk becomes far more prevalent in the market, real yield will start inching up, and that would be the driver of rates going somewhat higher. Right. Not substantially higher, but somewhat higher than where they are right now.
That's a really interesting point, which I would like to elaborate on later. Matt, you made a point earlier that I think is also important, that it's going to be very hard for U.S. yields to rise materially when you have a backdrop of such low yields around the rest of the world. Take a listen to what the Bank of Japan chairman, basically the Bank of Japan, Haruhiko Kuroda, said earlier this week. He backed Chairman Powell's lower for longer narrative. Take a listen.
This policy stance is based on the recognition that it will take time to overcome low inflation once it is entrenched. As you know, this is also a lesson learned from Japan's experience of prolonged deflation.
So, Matt, do you think that the U.S. yield market could increase materially with lower prices without a commensurate move around the world, in Japan, in Europe?
It's possible, right? Anything's possible, but that's difficult. That's certainly difficult. Again, we're in a range now, versus bonds, basically, where we're very close to its 5-year average, very close to its 10-year average, sort of that half a standard deviation between either. So we're in a very normal range. So it's certainly possible to get above that range, but it's difficult. It's difficult if some of the economic data and the soft data doesn't force you there. So you'd asked before, sort of, what is that catalyst and what can drive us higher? And honestly, it's very difficult, as you know, to pick the catalyst, but we do think time. Time is important. Just waiting through this, seeing us work through the soft data, see people coming back into the labor force, seeing people continue to get jobs. This is never going to be a one and done or a simple move. It's always going to be move, counter move, move, counter move. So it's going to be important to see how the Fed reacts to the incoming data and how they possibly adjust the taper timeline if things don't play out as expected. And it's also important to note that historically, and again, the mechanism is not really fully understood, but historically, when the taper actually stops, a lot of times you do see a dip in yields. That is not uncommon in the last sort of 10 to 12 years of, when they start to announce a taper, things move. And then when they stop, they actually start moving down again. So it's not impossible. So to get back to your question, we do think we can move slightly higher and hopefully get to that 215 sort of 10-year target that Bank of America Securities has by year end. But it's going to be difficult if we don't see a continued rise in global yields. But we are seeing that. This is not a U.S. only phenomenon. Germany's still, hopefully about to crawl into positive territory. And that's not great, but that's been a big move up. So the rise in yields has been global. It has not just been the U.S. It's just that the differential has sort of stayed in line. It's moved a little bit quicker. So again, unless you see that large move continue across the globe, it will be difficult to see them continue to move up.
Well, there's a lot here, and we're going to be digging through it. Everyone sticking with us. Up next, we'll talk about that supply demand, the auction block. There's no stopping the junk bond sales bonanza, racking up yet another record. That conversation, as well as Treasury sales, coming up next. This is Bloomberg. Abramowicz in for Jonathan Ferro. This is Bloomberg Real Yield. Time now for the auction block. We kick things off in Europe, where a record-setting pace of ESG debt deals got another boost from a string of new borrowers entering the booming market. In the U.S., UniCredit and Morgan Stanley raised a combined $5 billion on Wednesday alone, bringing this week's high-grade tally above $36 billion. And another record for U.S. junk bond sales, recording the busiest May on record, with the pace of debt sales nearly doubling from the first half of 2020. Despite the hunt for yield, investors pulling nearly $1.5 billion from U.S. high-yield funds this week. Priya, Misra, Matt Diczok, and Krishna Memani still with us. Priya, we ended before you could really give a sense of why you think that yields could go so much higher. And I think that this is pivotal. Can you tie why you think yields, as far as benchmark rates, could go materially higher with this idea of demand for riskier credit cooling? Could there be a similar sign from both?
So I think for riskier credit, it's really a function of valuations. Those spreads are so tight that you kind of wonder if you're getting paid up for taking on additional credit risk, additional illiquidity risk. For the rates market, I would say, it is a more liquid market. It's safe, but you're taking on duration risk in an environment where if the Fed is going to start to announce tapering. So we do have a very range-bound rate forecast right now, but by year end, when we think the Fed starts to signal tapering, that's when we are forecasting higher rates, because we have a ton of supply, particularly long end supply. So the duration hitting the market is high at a point where if the Fed is signaling stepping away, we think rates will need to rise, real rates will need to rise to attract investors from other asset classes. So can your scenario unfold with a taper tantrum? You're essentially asking, can a taper tantrum happen in 2021? And I think it could. The Fed is trying very hard to say, we'll give you advance notice. Well, then the taper tantrum happens when they give us the advance notice, not when the tapering happens. The market's much less liquid today than it was in 2013, and we have a lot more debt. We're much more leveraged. So I would argue we can get a taper tantrum if the tapering advance notice happens earlier than what's priced in, so fourth quarter of this year. I think we could get an environment where people just stay away from long duration treasuries as well as riskier assets.
Krishna, do you agree?
No, I don't agree. I think there is going to be some reaction to tapering, but I think because the growth outlook, in 2022 and 2023 is going to go down materially from what we have seen in 2021, that will end up tempering the taper tantrum. I think the analogy that we are drawing from the last 10 years with respect to taper tantrum, I don't think we had the growth outlook where we have it, or we had growth at the same level as we had in 2021. slowing down to a level that is probably likely in 2022. I think real rates are probably going to go up some, but I don't think it is going to be substantial, and I don't think it'll be as much supply driven as much as it would be because the Fed is backpedaling a little bit.
Matt, what's your take on this, especially this idea that you could see another taper tantrum at a time when there is so much cash out there?
So nothing's impossible, and you could see another taper tantrum, but we don't feel it's likely, and we feel it kind of already happened. That move from where we started the year at about 90 basis points on the 10-year, and from the low of during COVID around 50 basis points or so, that large move up to where we are now, approximately of 1 3/4, that felt very taper tantrum-like. We've seen rate moves like that several times since the global financial crisis. We've got a valuation monitor we look at. It's worked a couple times. It worked this time as well. It's not that difficult. Anytime the 10-year Treasury is that far below the inflation rate that the Fed's targeting of 2%, that's pretty much an excessive misvaluation. At some point, that's going to correct. And so that kind of already happened. So we don't expect another taper tantrum. We figure that's worked its way out.
Priya, do you want to respond?
So I would say I agree with both those points. I mean, we're talking about magnitude, how much, and we're looking for 2% on 10s. So I'm not looking for another 75 basis point rise. But I do think the market has become a little complacent about the Fed support staying with the market for a long, long time. And as that support starts to get away, I think we sell off, 20, 30 basis points in real rates, another little bit in break evens, get to 2% on 10s. And then you start to bring in buyers. And, to Krishna's point, we do expect a drop in growth next year. So treasuries will look attractive. Rates have risen. So there's some hedging property of treasuries, which were not there, I would say, last year. It's coming back. So we'll find buyers. It's just the question of what's the clearing price, and I think it's closer to 2%.
Krishna, is the junk bond market currently frothy, given this idea of peak growth, given the idea that everything seems priced to perfection?
If you've been a credit investor through cycles, you recognize junk bond markets seem frothy far more frequently than one would expect to be the case. It's just credit investors move in one direction, everyone. So either they are buying or they are selling. And I think the junk bond market is, the valuations are reasonably stretched. I wouldn't be a buyer. However, if your asset allocation requires you to buy junk bonds, it's really there. You don't really have too many other options that you can go out and explore out there that'll meet your criteria. So the point I'm trying to make is, yes, markets seem frothy, but don't count on that to kind of divine which way spreads are going. The markets can remain frothy for an extended period of time. They have historically, and it's probably going to be the case this time around as well.
I thought you were going to say that the market can remain frothy for longer than you can remain in the market and keep your shirt. Everyone sticking with us. Still ahead, we've got the final spread, the week ahead, featuring Chairman Powell and the U.S. payrolls report. That conversation coming up next. From New York, this is Bloomberg. I'm Lisa Abramowicz in for Jonathan Ferro. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up on Monday, U.S. markets closed for the Memorial Day weekend, plus the OECD publishing its economic outlook. An RBA rate decision coming on Tuesday, the Fed's Beige Book, and Eurozone PPI on Wednesday. I'll be talking about why that may be interesting on Bloomberg Surveillance. And on Thursday, another round of jobless claims, plus EU and U.S. PMIs. And on Friday, closing out the week with Chair Powell and the U.S. payrolls report. Still with us, Priya, Misra, Matt Diczok, and Krishna, Memani. I want to dig a little bit more into where there could still be value. We've been talking about all of the gloom and doom. And I'm wondering from you, Matt, where do you see within the fixed income complex the greatest potential opportunity?
It's difficult. You gave me the hard question there. It's very difficult to elaborate on Krishna's point. I'm not sure I would use the word frothy, but certainly high yield is fully valued. Our framework for looking at asset markets is, business cycle based. And so we expect spreads to be tight as we come into the upswing of the economic cycle. And we're there now, but they've moved very quickly, very, very fast. And for example, triple C debt right now is trading at approximately 6.5%, 6.75% yield. That is below average credit losses of close to 7.5% to 8%. So that looks excessively misvalued in our opinion. So we think the right way for investors to think about this is if you want to tilt to be slightly short duration, and while the yields aren't fantastic, to overweight spread products, high quality spread products, munis, investment grade corporates, agency mortgage backs, because if the 10-year treasury is where it is right now, around 1.6 to 1.7%, 90 basis points on investment grade corporate bond spread doesn't seem fantastic, but that's a huge percentage of your treasury yield, and that will add incremental yield over time.
Just for the sake of time, I'd love Krishna to get a quick response in. Where's the greatest value?
Well, so I don't think credit markets is where the greatest value is. And you'll get some yield and spread, but that's not really value. I would say the greatest value is probably EMFX. It's not a fixed income market, but I think EM currencies can strengthen a lot because real yields in EM can go up in the current environment, and the economic outlook, growth outlook for some of the commodity producers is actually increasing. So my vote would be for EMFX far more than traditional fixed income markets.
Priya, 20 seconds before we get to rapid fire. What's your response?
I would say long end inflation expectations. The front end's perfectly priced. 5-year, 5-year, 10-year, 10-year. Those inflation expectations, I think, have room to rise. If the supply chain disruptions last longer, I think that's the part that is going to move higher.
All right. It's time now for the rapid fire round. 3 questions, 3 quick answer. So I just want to give you a sense. First one, is the high yield bond market poised for a blow up? Starting with you, Krishna.
No.
Matt.
No, it isn't.
Priya.
Not right now.
Okay, not right now. The other question is, which is the worst pain trade? Treasury yields going up to 2.25% or falling down to 1.25%? Priya.
1.25%.
Matt.
Falling.
Krishna?
1.25%.
All right. And going forward, what is the bigger risk, investment grade or high yield credit? Priya?
High yield.
Matt?
High yield.
Krishna?
High yield.
All right. Well, thank you to all of you, Priya Misra, Matt Diczok, and Krishna Memani. It was a fascinating week, remarkably dull in terms of yield moves, however, very interesting when it came to inflation expectations. From New York, that does it for us. This was Bloomberg Real Yields. This is Bloomberg.